going to be televising. There we go. That is on. We're going to be televising part of our interview with President Harker today. So we are just waiting for the introduction from Bloomberg Television and Radio, in which that we can begin giving him the third degree. I thought that that last panel was very good because they basically laid out all the questions we need to ask you. All the things that they're worried about and concerned about are going to be brought up. So we've got about a minute to go here. You've been the president of the Philadelphia Fed for about 2 years now?
3 years.
3 years. Yeah. Time flies when you're having fun.
That's right.
We're 30 seconds away from television, and are you having fun?
I am having fun.
At an event like this, you can't help but, right?
That's right.
Well, we welcome you. So I'm just waiting for them to introduce us, and I will introduce where we are. We will go for about 30 minutes, and then the audience will have a chance to ask questions as well. Good morning from Victor, Idaho, and the 10th Annual Rocky Mountain Economic Summit. We welcome everyone joining us live on Bloomberg Television and Radio worldwide. I'm Bloomberg's International Economics and Policy Correspondent, Michael McKee, and my guest today, and the guest of the summit here, is the Philadelphia Federal Reserve Bank President, Patrick Harker. Thank you for joining us today.
Thank you, Michael.
Let's start with the elephant in the room, or we don't know how big it is. It may be a marmot in the room at this point, and that is inflation. CPI today came out 2.9% on a year-over-year basis for the headline number. The core is at 2.3%, highest in 6 years. Are you worried? What's your read on inflation? Is this a collection of one-offs, or are we finally starting to see inflation build and force the Fed into maybe a different policy path?
Well, thanks again. Thanks for having me, and I'll give the standard Fed disclaimer. These are my thoughts, nobody else's. Keep it short and simple. On inflation, you used an interesting word, worried. Why would we be worried in the sense that inflation's moving toward our 2% target? It's not accelerating rapidly past it, it's moving toward it. That's what we've wanted all along. So I think this is actually good news. Now, if you break that report, the CPI report, down a little bit from this morning, goods inflation is pretty much flat. It's services inflation that's starting to see some increase. And since we are dominantly a service economy, that's something to keep watch on. I mean, we spend a lot of time, and we'll spend a lot of time, I'm sure, in this conversation, talking about trade and trade issues. But remember, and put it in context, the dominant part of the U.S. economy is services. And so service inflation is what I watch most closely.
Well, the CPI is not the Fed's favorite method of calculating inflation. The personal consumption expenditure index tends to run maybe 3 to 5 basis points below. So if we're at 2.9%, then maybe we're 2.5, 2.4 for PCE. Yeah. That's not 2%.
No. And I think what we've always said is that the target is symmetric. The 2% target is symmetric. Moving to, say, 2.5 and sort of staying there, I would be comfortable with.
For how long?
I can't say, because again, I think it's a question of acceleration as opposed to, and the change in inflation as opposed to the overall number. So if we're accelerating past 2.5, then I do think we have an issue. But the other thing we have to do is look through some of those numbers to not just the core, excluding food and energy, but again, breaking it down in my mind between the goods sector and the services sector. Because services are driven by primarily labor. And if we're starting to see large increases in service inflation, we will start to see those wage increases as well.
Well, if we get those wage increases, or even if we don't, with a growth rate 3% or better in this quarter, in the most recent quarter, and perhaps in this quarter as well, does that change your view of how many interest rate moves you need to make?
Yeah. So in the beginning of the year, I had put in 3 for this year, 3 for next year. I've not moved off of that, although I am open to a 4th increase this year if we do see inflation starting to accelerate.
Well, that raises the question of where you stop. If you had 3 this year and you do 4, does that mean only 2 next year, or do you go farther?
Yeah, I think we just need to let the market play out, and need to let the economy play out and see where we are in the next quarter, next year.
Well, there was an interesting story today. The spread between the December 2019 and December 2020 euro-dollar contracts, and this is going to be a little bit wonky, fell below 0. But what that suggests to the market is that the Fed in 2019 is done, and that there is a chance that by 2020 you'll have to be cutting rates.
I don't know. My crystal ball is not that good. And so I do think that we should be pragmatic and prudent about these increases. I think the term that we've used, and I am strongly supportive of, are gradual increases. That's why I've not moved off a 3 yet this year. That doesn't mean I couldn't support a 4th if the data evolves in a way that would support such a move. But right now, I think we should just take this slow and steady, as we have done in the last few years.
Okay, the guy on the trading desk is raising his hand and saying, well, what's that 4th move dependent on? What are you looking at?
I think it's inflation. Again, if we see inflation starting to go and accelerate past 2.5%, then I do think we have to act. Absent that, I think there are lots of good reasons to hold off.
Well, you, in June, as did your colleagues, submitted new economic forecasts for the rest of this year, 2019, 2020. So can you give us what your forecast is? How fast do you see the economy growing? Where's unemployment going, and where does inflation go?
So we see growth around 3%, like we're seeing now, and ticking back down over the next couple of years to trend growth at 2%. Unemployment, we see, is coming down a little bit more, maybe 3.6. Now, it went up because of what we see more people entering the market, but the evidence is pretty clear. Our economists in Philadelphia have done a lot of work on the demographics. We're going to look at labor force participation over the next 5 years, possibly going down another 2 percentage points, just because of the demographics of us, the boomers, leaving the market. So that is, although it's good news that more people are coming off the sideline, I don't think we can bet on that for the long term. So we'll see unemployment come down a little bit, maybe 3.6, 3.5, and then tick back up.
Well, when you make those forecasts, then you also tell everybody what you think optimal rate policy is based on those forecasts. So where do you see the Fed stopping in terms of interest rates?
So I think the long-term Fed funds rate will be around 3%. We could go slightly above that, maybe 3.25%, but I think the long-term rate, assuming, say, the neutral real rate it moves up to 1%, inflation stays around 2%, then we're at 3%.
Is that a moving target as the economy maybe grows faster because of the stimulus?
Sure, and I think we could overshoot that a little bit. I ideally would not like to do that, but it's possible that we could overshoot, and that's why I say we could get to 3.25% before coming back down to 3% long run.
Let's talk about some of the risks here. Mike Drury was talking about trade wars, as was Megan Green. In your view, is what we've seen so far a serious threat to the economy?
So I think what we've seen so far, and what the presenters in the last session discussed, and I think they said it absolutely right, is we've seen concern, but the overall issue right now is not going to affect the economy in a significant way, absent one fact. So the actual numbers, if you run the numbers, and the percentage of GDP as described in the last session, it's not a big number. However, if it affects confidence, then I'm worried. And this is what, at least anecdotally, we're starting to hear a little bit. That firms, not large firms, but small, medium size enterprises, who are looking at making some investments, are now saying, at least through our survey work and through interviews, we may hold off on these and just see how things shake out. If enough of that happens, if we lose those animal spirits, then I think we have an issue. Because again, it's a self-fulfilling prophecy. If everybody believes this is going to have a larger impact than it may in fact have if we run our models, then it's going to have a larger impact.
Well, what is the constituency you represent telling you? You speak with CEOs all the time. Where are they on that question?
Again, for many, especially large firms that have access to deep pools of capital, not really affecting them that much. It's the smaller, medium-sized enterprise. I was talking to a fellow recently, a firm that makes parts that go into other things, that hold other things. Main feedstock he uses, stainless steel. You know, this is not a good time for him right now in his business. There's a local manufacturer in the Philadelphia region, is the last remaining beer keg manufacturer in America. And his concern, of course, is with the tariff, he can't compete because you can import a beer keg with no tariff, but aluminum comes in with the tariff. Now, I want to make sure all the college students in America understand that this is not going to be a problem in the long run, that this will be solved.
I was going to say, national security issue. But are we going to start to see what we have seen in the past? Have you seen any evidence that we see more layoffs than hiring because of tariffs?
Not yet. I mean, I think, again, it's too early to see that.
What about inflation? Obviously, there's a question about whether you import inflation because of tariffs, and the PPI came in much stronger than expected yesterday. Are we starting to see evidence that that could happen?
Yeah, I mean, if you talk, one of our major contacts is a multinational manufacturer and very diversified. And the prices he's seeing for metals are just going through the roof. And we're seeing this with wood products. Another one of our contacts was saying he's seen a 60% increase in wood products that he's had to absorb. Because it can't, as said in the earlier session, they can't pass that all along to the consumer right now, right, or through the supply chain. And so there are issues that we are starting to see in certain sectors. That said, again, we have to go back to what is the U.S. economy? It's predominantly a service economy. And so how will it affect overall inflation? I think that story needs to play out. It could have a transitory effect, or it could have a long-term effect. But in either case, until it filters through to almost 80% of the economy, services, it's not going to move the inflation needle in a major way. I do think we're starting to see, particularly around healthcare, some movement of price increases in healthcare, which is almost, bumping up to 20% of GDP. When that starts to happen, then we're going to see inflation accelerate.
Do you or your economists sense any change in inflation dynamics in that for 10 years we've been told that we can't pass along any prices? Right. Are there any companies in your district that are starting to dip a toe into that water?
Yeah,
and what kind of result do they get?
Yeah, so they're starting to get some mid-year price increases. One of our contacts said, I've never had mid-year price increases for a long time. I'm starting to see wage increases mid-year, price increases mid-year, and they're being absorbed. The other thing that I found interesting in the conversation with this individual was not only are firms okay with absorbing the price increase, but they're also okay with the backlogs growing. I mean, his backlogs have gone from several weeks to 60 weeks. And the thing is, he can compete because everybody's backlogs have grown the same way. And so we're starting to see dynamics in the market that do make you think that inflation will accelerate. But I think I'd like to see a little more evidence before I'd support the fourth increase this year.
Well, let's talk about the wage aspect that you just mentioned here. Are we starting to see the wage increases that the Fed has been expecting, the Godot of the economy for many years?
Yeah, so on average, the answer is no, but averages had a lot, right? And so the big question is, what's going on with wages? Well, there are a variety of competing stories, right? And a variety of competing rationales for why we're not seeing this. Some of it is a compositional shift, as mentioned earlier, from, say, a higher wage goods producing firm to a lower wage service producing firm. There's a demographic compositional shift from higher wage boomers to lower wage millennials. Robert Samuelson in today's Washington Post has an article that sort of lays out all the likely suspects. The reality is probably all of the above. There's no one explanation for why we're seeing this. It's probably all those factors. But what's clear, and I think this is clear from a lot of the conversation we've been having in Philadelphia and really across the system, is what we're seeing is heavy demand for low-skill workers, farm workers, et cetera, heavy demand for high-skill workers. It's that middle-skill job that is being automated away with AI and machine learning. And I think that's what we need to sort of focus on for the long run, right? How to bring those people and into this new economy. And if there's a frustration I have in all this conversation right now, is we're not focused enough on those long-run issues.
Well, you're a former educator, of course, the former president of the University of Delaware, head of Wharton. Is there an easy answer?
No, I think, as I said in a previous event, somebody asked me, how do you guarantee lifelong employment? You have to engage in and commit yourself to lifelong education. There is no simple answer to this. And so firms have to invest in upskilling their workforce. Higher education institutions, particularly junior colleges, play a critical role in this. They are, in my view, the unsung heroes of the American higher education system. They're the ones that are on the ground working with employers, bringing people those skills. That is where we need to reinvest. And what we've seen in the aftermath of the Great Recession is a lot of those community colleges, they don't have the capacity to meet the demand just simply because the county budgets and the state budgets have been so constrained.
The other big issue for you and your colleagues, according to the Fed minutes, at least at the June meeting, the flattening yield curve. Yeah. What do you think the yield curve tells us now? Is it the kind of guide to future economics cycle as it has been?
So this is an active debate, of course, going across not just the Fed, but across the economics profession and markets. So here's where I'll put my engineer hat on, the pragmatist hat on. Whether it causes recessions or is correlated with recessions, it sort of doesn't matter to me. And it's a good argument, and it's something that we should continue to research. But at the end of the day, if I'm an engineer designing a system, and I'm trying to, and that system can become turbulent or chaotic, my job is to keep away from it being turbulent or chaotic, right? Yeah, I could design something that could work in a turbulent environment, but why, right? Let's try, if I can keep back from that, we should do that. And I think the same thing should happen with monetary policy. This is why I'm not yet ready to commit to a fourth increase. If there's a risk of inverting the yield curve, we should try to avoid that. I don't see, there's no compelling reason right now why we have to have that fourth increase unless we see inflation start to accelerate rapidly. Absent that, I'd like to stay back and stay away from that turbulent, chaotic regime.
Well, there was an interesting chart in the last presentation showing Fed rate moves and then what followed afterwards, and almost every time there was a recession. Do you think the central bank has learned something about where it should position monetary policy, or is it that you can't really know?
Yeah, so those charts are very interesting, but each one of those moments in our history is very different. Right? So some people have, when I've been talking to folks, have harkened back to the 1970s and inflation. That was a very different environment. It's hard to imagine an environment at 10% inflation and a lot we would learn in an environment now at 2% inflation, right? And also with a very different message from the central bank about targeting a 2% inflation level. So I think we have to be a little cautious in looking at those kind of charts. History is a useful guide, but it's not going to give us the answer.
The predicate you put in there about whether or not you need a fourth interest rate hike because you're concerned about this raises the question of at what point do you think the economy starts to slow down? There were several recession forecasts made in the last panel, anywhere from 6 to 9 months to a couple of years. What do you see on the horizon there?
So I think we have to go back. I can't, my crystal ball is not good enough to forecast exactly when a recession happens, right? Because secondly, I think we have to look at long-run investment in the economy. There could be a recession. I agree that I don't see the probability in the next 6 to 9 months much higher than the normal probability that we'd see in a market. That said, I think there's some longer-run issues about economic growth that we need to focus on that were brought up in the last panel. Right? We've still seen very sluggish productivity growth, and hence we've seen a very low neutral real rate. We are going, in my view, the wrong way with respect to labor force growth, and that's the real driver, and it has been the real driver of economic growth in the country. Now, the good news in the last report is that people are starting to come off the sidelines. But that is a complicated issue for firms. As one CEO told me recently, I got to take my high productivity people to go train people that don't know what they're doing. And as a result, my productivity's decreased in my plants, and it's going to for a while until I bring those people back up to speed. Individuals, firms, CEOs have to make that decision, whether or not to do that. Because there are not a lot of other people out there, skilled people. All you're doing is stealing from each other. And until we make a commitment to bring more people off the sidelines and or deal with the immigration issue, that we have in the country, I worry that the long-term growth of the economy will suffer because we're not seeing the labor force growth that we've become accustomed to.
Well, the other side of do you need the fourth rate increase argument is that you do, because the Fed funds rate is so low now that if you go into recession, you don't have the tools to fight it.
Right. So I think it is prudent to move away from zero in a calm, gradual fashion. Right? And I've been supportive of that in my 3 years at the Fed. However, I think if there are other risks, like the potential of inverting the yield curve, and as the previous panelists said, it doesn't matter whether it causes recessions or not. If the market believes it does, then it's a self-fulfilling prophecy. So if we can avoid doing that, I would prefer to do that and continue a gradual path of moving away from zero.
But how high do you need to go, not to put the economy into neutral, but to be able to respond. In previous recessions, the Fed's cut by 500 basis points on average, and you're only at 200 right now.
But I think we're in a different world as well. We have different toolkit than we did before, right? So in addition to the Fed funds rate, there are other tools that we implemented during the Great Recession, and they could be brought back into use if need be. Hopefully that doesn't occur. Hopefully, if there's another recession, it's a mild recession, we'd never need to reach into that toolbox. But I think it is prudent to keep those tools just in case.
Well, if you do use those tools, do they work? Yes, you have them, but there's a real debate about especially whether QE worked.
Well, and then you have to parse that out. QE 1, 2, 3. I think there's a different answer for each three of those because the markets were in a different place in each three of those. So I think the answer to that question is complicated. I don't think it's a simple yes, no, they work, they don't. I think they will or they won't work depending on the circumstances where you deploy them.
Tax cuts, are they behind the stronger growth that we are seeing now, or is it just a cyclical upswing?
So we've marked our forecast up 2 to 3 percentage 20 or 30 basis points because of the tax cuts, but it's going to have a transitory effect. We don't estimate that it will have a long-term effect. We'll go back to trend growth of around 2% over time.
Do you see any evidence that this tax bill is going to raise productivity, another issue that was brought up in the previous panel?
Yeah. So my sense of this is it will help small, medium enterprises. Where I see, and this is not only anecdotally, but also through our survey work, where I see capital being deployed is in those small, medium enterprises. I personally am more skeptical in the large corporates, whether this is having a big effect, because they already had access to a tremendously deep and liquid pool of capital. So I don't necessarily see it moving the needle there that much, but I do think it will have an effect on those small, medium enterprises.
Well, when you talk to CEOs, are they making the case, companies of any size, for needing or wanting to invest? Are they able to meet demand? Are they telling you that they can raise productivity, increase margins, or are we just sort of seeing people sitting and waiting? Because we're not getting a lot of capital expenditures.
Yeah, kind of all of the above. I do think that uncertainty, right, is causing people to sit on their hands for a while, which makes sense, right? I sat on corporate boards. If there's that much uncertainty in your industry, why would you make a major bet right now? Unless you're pretty sure that it'll pay off over time. And so we're seeing some of that. We're also, though, seeing firms out of necessity, in some cases, having to automate because they simply can't find the workers. We're hearing that more and more.
Do you think the tax cuts will prove to be inflationary at all?
I'm skeptical of that, in that we're not seeing, as you just said, large increases in capital expenditure, so we're not seeing lots of pressure on those CapEx, the things you would buy with that expenditure. So it may happen, but right now I'd be more in the camp of being a skeptic.
A couple other questions about things you might stay awake at night worrying about, and then we'll turn to the audience. Some of them were brought up again in that previous panel. Corporate debt, non-financial corporate debt at a record. A view that could be the trigger for the next financial crisis. Are you worried? What do you think of that?
It is something we have to watch, but right now I wouldn't put myself in the camp of being worried.
Do you think that you're going to possibly play a role in turning that story if you raise interest rates too high?
Again, this is one where we have to be prudent and just gradual in our increases.
All right, the question about financial markets, and John Sylvia noted that market reaction to perceptions of what's going on could be an issue. Do you worry about that? And also just the level of asset prices, and are they justified? Are there bubbles out there that you see?
So again, bubbles are hard to predict, and I don't necessarily see bubbles. Are the prices elevated? Sure. In some cases, firm by firm, that would be justified. In other cases, possibly not. The market participants here in the room would know better than I which of those firms, which is which. It is, however, something that I continue to worry about. And again, I'll go back to the point of being gradual. I mean, we don't have to make dramatic moves with respect to monetary policy right now. I don't see any compelling reason to do so, and I think the markets can adjust if we can do this gradually.
Now, what about overseas? We had the presentation talking about Italy and its problems. The European Union obviously has ongoing issues, questions about China and its sustainability. Sure. Does that figure into your thinking at this point? Any of those a big enough threat that it would hurt the United States?
Not at this point, but they clearly merit watching. And they merit, and through the channel of the dollar. I mean, if you think about our mandate of stable prices and maximum employment, the main channel that I worry about is the dollar and how it's going to affect our markets and our competitiveness going forward.
Other central banks around the world, including the European Central Bank, starting on the path to normalizing. Yeah. They're going to be raising rates at some point over the next year or so. Does that have an impact on what you do and on the rest of the world, or is everybody else still so low that you don't have to worry about it?
Yeah, I wouldn't say it has a direct impact. Of course, you're cognizant of it. But in our case, I have to go back to our mandate of the U.S. economy, and the effect those international economies have on our economy is how we have to look through that lens, not their economies per se.
All right, we can turn it now over to you, and anybody who has questions for Pat Harker can move to one of the microphones, and we'll continue the discussion. And while we wait for people to get to microphones, I'll let Jill, you pick whomever raises their hand or wants to ask a question. I want to shift gears a little bit and talk a little bit about you. You came to the Fed with a different background. I mentioned you were an academic. You were an engineer by training, an academic by trade. How do your skills fit in with a body that is thought to be generally economists?
Yeah, and the Fed is. I mean, we're the largest collection of economic talent in the world. But I think what makes the Fed work, and particularly what makes, in my view, the FOMC work, is a diversity of opinions. And a lot of those opinions come from our life experiences and our academic training. So I think what you see is people with different perspectives. For example, we just made a major hire in Philadelphia, a young economist doing machine learning work. He's just joining us this summer. Why? If you step back, and when I first got to the Fed and I dusted off my macro books and started to think again about the state of the art in macro modeling, think about what we do. We take lots of disaggregated information, we aggregate it into things like CPI, PCE, GDP, then we throw it in a beautiful model. A dynamic stochastic general equilibrium model. And then we try to make predictions. So if you just step back for a minute, you just threw away a lot of information that you then threw into a model, which is imperfect, there's model error, and you expect that you're going to get good results out of that. I think there may be other ways of thinking about economic modeling, like many economists are now starting to think about. There's a toolkit coming out of machine learning, a statistical toolkit, that may have some applicability to what we do, and that's this young economist who's joining us. And I think that's what I bring to the table. It's sort of part of my job as a Fed president or as a university president or as a dean prior to that, is just to ask the question, why are we doing it this way as opposed to that way? It's not necessarily to do the work, but to ask the question. And so we asked that question. We put a conference together joint with Penn Computer Science at the University of Pennsylvania, half economists, half machine learning people, and out of that came an insight into, I think, my group in Philadelphia that we should start to invest in this area. There might be a there. I can't tell you exactly what it is yet, but that's what research is about, right? You don't know where you're going to end up. But that's what the Fed needs to do. That kind of research is going to move the needle forward in possibly unpredictable ways.
I know there's some venture capital guys out there that might want to invest in your efforts. Okay, Jill, we have a question.
What are your thoughts that given demographics and the state of technology, that going forward, interest rates will be significantly lower in the future than they've been over the past 40 years?
I think there is an argument that the neutral real rate, until we see productivity really tick up, will keep rates low because we're not seeing that productivity increase. And again, if I pull back, where we need to see that productivity increase is in services. Right? We are predominantly a service-based economy. And in a previous conference, Chad Severson and I were on a panel together, and Chad from the University of Chicago, and he made the point that one of our economists, Leonard Nakamura, has done really deep, thoughtful work on mismeasurement of inflation and productivity, and particularly around services. You think about most services, how do you measure the output of a professional service firm? Well, there's various ways, but essentially it's input. Billable hours are output, billable hours are input. And so by definition, there's zero productivity growth. And we can go through every healthcare. How do you measure productivity of healthcare? This is a debate that health economists have been having for decades. But we're now, if you take the healthcare, financial insurance, real estate, and business and professional services, we're well over 40% of the economy that we have problems measuring, right? Even what inflation and productivity are. So I think there, again, we need to put more emphasis on trying to understand those inflation dynamics in those industries. We're very good at understanding inflation dynamics in ag, in manufacturing, and these are important. But we need to really understand how to improve productivity of services, given just the math, if we're going to move the needle on productivity overall in the economy.
I don't have a chart here, but I'll draw one. The productivity we saw in that graph earlier, went up during the PC revolution.
Right. It's
come back down. Does it go? Are you in the camp that says it goes back up again, that we get some marvelous jump in productivity, or do you think we're kind of in the Robert Gordon, we'll have some slow increase in productivity, but nothing major?
Yeah, so I'm not in the Gordon camp, and I'm not in the Eric Brynjolfsson camp either. I'm sort of somewhere in between. I mean, technology is, throughout human history, has been hyped. I mean, you can imagine the first person that came up with the stone knife, and that he tried to sell stone knives to all his fellow members of the planet. I mean, yeah, that had an impact, but it takes time. Sometimes it's overhyped initially. Will AI and machine learning have an impact? Absolutely. Will the machines, make us subservient to them I don't believe that. I think that technology can have an impact. There are certain sectors where we're going to see some movement. And again, it's that middle skill job, right? Or as my colleague Dave Altig at Atlanta has talked about, if you think about jobs as routine, non-routine, cognitive, non-cognitive. If you're doing a routine cognitive job, if you are a young lawyer just reviewing corporate documents, you got a problem. Because the machine, or what you're doing, if you're a young associate, you're flagging the 10 things that the partner needs to look at in that 300-page document. Well, the machine can do that pretty well too. So this means we need to reconceptualize, in my view, how we educate the future generations. And this puts my academic hat back on to meet what those jobs of the future are going to be. I am not in the camp of the machines are going to take away all our jobs. We've always created new jobs. Go back 20, 30 years. How many web designers were there in the world? I mean, we've always created new opportunity, new jobs, but it does create you need a different skill set to meet those jobs.
Have another question here.
Back to interest rates. What is your thinking on the efficacy and probability of negative interest rates during the next recession if it were to be deeper than you are currently thinking?
So I would never say never, but I would have a high bar to cross before I would support the U.S. going negative in rates for a couple of reasons. One, the evidence, again, like we were talking about, the evidence in QE is somewhat mixed. The evidence across the globe on negative rates is somewhat mixed. Second, there are a lot of structural issues in the U.S. economy with respect to going negative that we'd incur some significant costs, I think, to do that. And third, and I think there are other tools that we can use before we'd have to deploy that. So I'd never say never, but right now I would not, it would not be the first thing I would reach for.
Negative interest rates being one tool along with QE. A third is forward guidance.
Sure.
And there has been a question about, are you ready at the Fed to stop doing forward guidance, to stop saying that rates are accommodative, that they will remain below the target, et cetera?
So I think forward guidance was essential during the crisis for us to commit to keeping rates low for long so that the markets and organizations could react accordingly. I do think that there's an argument, and I'm sympathetic to this argument, that it's lost some of its oomph, that we don't maybe need to do that as much, because the markets also tell us whether they think our policy is accommodative or not. It's not, I don't necessarily see why we have to say it, the markets are saying it. That said, I do think there are times in history where forward guidance plays a larger role than possibly today.
Do we have another question? Not at the moment, so I'll continue. Oh, we have one over here if somebody wants to bring a microphone to that side. Susan?
What would you say the long-term or impact of this groundswell of cryptocurrency is and digital currencies?
Yeah, so this is where I have to separate those two terms, because those terms get bandied about quite a bit. Digital currency, we've had digital currency since the advent of the computer, right? The vast majority of money moving around our economy is digital. So I think there, we really then have to focus on the cryptocurrency world, the Bitcoins and et cetera of the world. And there, I think the jury's still out. And I think my stance has been to let that evolve and see how it evolves and just be watchful and see what we can learn out of that. There are some pros and cons to that technology. Distributed ledger technology has lots of advantages, but some of the consensus, at least from the researchers I've been following and some of my old colleagues, is it has an absolute advantage on highly complex transactions that are relatively infrequent, because it costs a lot to do it, right? Simple transactions that are very frequent, it's not obvious it has the same advantage, right, if you just think about it. Because it costs a lot to run a system like Bitcoin the way it's run. The other thing that I think we can't avoid, whether it's in Bitcoin or in US dollars or euros or yuan or whatever, is it fundamentally comes down to trust. I mean, think about Bitcoin. Why is Bitcoin value going up? Because the people who compete and trade in that market believe that it's a limited supply of Bitcoin. And why do you believe that? Because somebody told you that. Could that change? Yes, it could change. And so any currency, and I think this is important to note, any currency, whether it's the US dollar or any non-asset-backed currency, right, is fundamentally about trust. And I think you can't avoid that no matter what technology you use.
Do you think any government is going to let a cryptocurrency substitute for its currency?
Well, I can't speak for any government, right? But I don't see that in the offing, at least for now. Again, I would never say never, but for now, I don't see it.
Joe has another question.
Thank you. The question is about quantitative tightening, which is scheduled to accelerate in the second half of this year. Do you see under any circumstance where the Fed would change the pace of QT and slow it down?
So again, I can't speak for the Fed. I'll just speak for myself. Right now, I believe that we committed to a gradual path of the balance sheet reduction, and we laid out the caps and the increase in the caps. I would like to stick with that. I think that if it's having an impact on the market, it is small relative to other things happening in the market today. And I think there's a lot of advantage for us to say we are going to do this and to do it and go back to a balance sheet that we need to implement monetary policy.
Has your thinking changed on the size of the balance sheet that you need? Do you have an idea of where you might want to stop? Some are suggesting stopping sooner than maybe you thought when you went into it.
Well, that gets to a deeper issue of, so once you take away all our liabilities, whether it's the Treasury account, the currency liability, the question is, what level of reserves do we need to implement monetary policy? And here there's a discussion about whether we run a corridor system or a floor system. I think the general consensus, and I am supportive of that consensus, is a floor system. But that requires a Fed funds market that is functioning and other tools to make that market work. And there, we don't know exactly where that bend in the demand curve is, right? We don't know exactly where the corridor kicks in from the floor. The estimates are all over the place. I mean, some people have it at $100 billion. Some people have it at $1 trillion. So pick a number in the middle. We'll be very scientific about this. Say 500 to 700 billion. You add that on to the other obligations, and you get some number that pretty much is where the consensus is right now. But I think, at least for me, we will know when we start to hit that point, right? But we don't know. We can model it, and we've modeled it extensively in Philadelphia and elsewhere through the system. But we don't know exactly when we're going to hit that point. So that's why I at least can't pre-commit to exactly what the size of the balance sheet will be, because it's impossible to, once we commit to something like the floor system or the corridor system, and we want to be there, then we have to have reserves to actually operate that system.
We should probably explain the corridor and floor system to people.
So it's pretty simple. I mean, what's the demand for reserves, right? And so right now, given we're flush with reserves, this is not a lot. And as you start to remove reserves, you start to create an elastic demand curve for reserves, right? You start people starting to want more. So we don't know exactly where that bend in that curve is.
All right, if the Fed does make it, well, let me ask, when do you think you'll know?
We just have to watch the markets and see how the markets react.
Do you make the decision about a corridor or floor system, or do the markets make it for you?
I think it's a combination of the two. I mean, obviously, we ultimately make that decision in the sense that we are implementing that policy. But yeah, we have to be cognizant of the fact, because we're implemented through the market. And so if the market's not going along with us, that's a problem.
Joe?
Just a follow-up, because of the question that Mike raised, we're about to change to SOFR, a secured overnight funding rate. We've had issues between Lois, LIBOR, and OIS.
Yeah.
The Europeans are changing their reference rates. There's a chance that we won't have 5 institutions in a LIBOR setting,
right,
and changes in LIBOR contracts. Does this go into the Fed's discussion when
Sure.
you're in the meeting, and how do you deal with these kinds of strategic changes?
So for me, again, I can't speak for the Fed. For me, there are a lot of changes going on. We should try to minimize the risk that we would add into the markets by making these changes. I think in some cases these changes are appropriate, and I won't speak to which ones, but I think they're appropriate. But we should implement it in a way that is not disruptive to the markets in any significant manner. I mean, there's already enough uncertainty and volatility in the world. We don't need to add to it.
We have other questions from the audience. Anybody on this side? We only had one question on this side, and we hate to be unbalanced here. So if anybody has any other questions, you can raise your hand. I don't want to monopolize the conversation. We have just a few minutes left. And while we wait for everybody to get brave, let me ask you this. On your Bloomberg terminal, and everybody, of course, has one, what's on your homepage, your dashboard? What do you watch on either a day-to-day or week-to-week basis in terms of the economy, the markets? What's the most interesting thing that tells you something about the world?
You know, it's not on the Bloomberg terminal. Uh-oh.
Well, tell us. We'll put it on there.
It's because I think what we need to do is create the conditions for long-term economic growth. We don't create growth. We create the conditions to help real people, real organizations do what they need to do to create growth. And that means we have to have a long-term perspective. We should not be reacting to short-term market volatility. We shouldn't ignore it completely, right, to see whether it's noise or a signal, but we should not be reacting policy-wise to every single up and down in the market. And that's why what I meant by I don't watch the Bloomberg term. Rather, I'm looking at longer-term trends like labor force participation, productivity growth. Those are things that are going to drive the economy in the long run. So, yeah, I mean, obviously issues like the shape of the yield curve matter to me in the short run or in the medium term in terms of policy. Because again, back to our previous conversation, I would like to avoid inverting the yield curve if for no other reason other than the market would take that as a signal that a recession is imminent, whether it is or not.
Well, there's a name for reacting to asset market developments. It was called the Greenspan put and the Bernanke put and the Yellen put. Is there a Powell put? Is the Fed still sensitive to what happens in the markets? Can the markets push you in terms of monetary policy?
Again, I can't speak for the Fed. The markets are the way we fundamentally implement monetary policy, right? So you have to be sensitive to the markets. But I don't sense any put right now.
So if the markets fall, doesn't necessarily change your policy path.
Because we've seen they fall, they go up. I mean, I think we have to look through a lot of that short-term volatility.
Let me ask you one last question, unless we have any others out there. What's the biggest threat to the economy and the thing you worry about having to react to at this point? I hate the cliche of what keeps you up at night, but if you were to wake up at night, what would you be thinking about?
To me, the things I worry most about aren't in the wheelhouse of monetary policy, right? I mean, long-term economic growth of the economy is not in the hands of monetary policy. We're not the ones driving the ship. We have to create the conditions for growth, as I said earlier, but we're not the ones driving the ship. If there's something I worry about, it's the need for us to focus on what investments we need to make as a country for long-term sustained economic growth. And what I worry about is right now, I'm not hearing a lot of that conversation. I mean, there are organizations like the Committee for Economic Development out of the Conference Board, had the book they put out last year on sustaining capitalism that had some sensible things to do, whether you agree with them or not. But I think we need to start to develop a consensus, a conversation around what do we really need to do, put politics aside, on our education system. If our young people aren't educated for this new world where technology is going to play an increasing role, we're going to fall behind. At the same time, we need to keep investing in that technology, et cetera, et cetera. And I think there's a set of long-term policy issues that I am not hearing enough conversation about right now. And again, it's not criticizing any one particular group or person. That's not, but I think we need to get back to having that conversation. What is in the best long-term interest of this country, and what kind of investments do we need to make?
Great bipartisan advice from Patrick Harker, the chairman of the Philadelphia Federal Reserve Bank. Thank you for being with us today.
Thank you.